Welcome to this video about the Utility Elicitation Program. This tool is for calibrating an organization's or an individual's risk policy. I'm John Schuyler, a decision analysis consultant and trainer. My career has been mostly about corporate planning and decision analysis. A particular interest is in decision policy, how people and organizations measure value. Let's preview this video. Decision analysis is a discipline that helps people make good decisions under uncertainty. The analysis involves probabilities and projecting outcome values. Decision policy is about how we measure the quality of the outcome. Risk policy is a part of decision policy. This guides in making value versus risk trade-offs. A graphical or mathematical utility function is the tool for doing this. One curve, an exponential utility function, has very good properties. We define its shape with a risk tolerance coefficient, abbreviated RTC or R. The Utility Elicitation Program, UEP, is a tool to help a decision maker determine the risk tolerance coefficient. It works by presenting the decision maker with a variety of hypothetical investment decisions in various forms. Depending upon the question type, the user judges either a threshold probability, the value of a risky project or asset, or the optimal ownership share of a large project. From the answer, UEP calculates R. The decision maker repeats the process until R reasonably converges. The UEP user interface is a common web browser. Here's a view of the initial screen. Clicking either Random Question or Next Question button generates a hypothetical decision opportunity. Here is a sample question in text form. UEP is asking you to assess the value of this risk. Suppose you judge that $12,000 feels about right. Answer 12 in your answer box. UEP responds with the imputed R, $119.6 thousand. With practice and feedback, you can expect to become calibrated for risky situations. Your R's should reasonably converge. Pick a value among the calculated R's, and now you have your risk policy. Here is a map of your present options. If you are already familiar with utility functions, you may want to proceed directly to the portal page that links to UEP. The web address is repeated at the video end. If you prefer full detail up front, you may want to choose among video and written materials at that same web page. Or continue with this video for a quick overview of decision analysis, risk policy as a utility function, and an introduction to UEP. This video is a consolidation of about 1/3 the combined length of 3 other videos available on the portal page. About 2/3 of this presentation is an overview of decision analysis and utility concepts before we even get to UEP. The discussion about risk policy begins on slide 14, about 12 minutes into this video. The UEP tour part begins on slide 38, about 35 minutes into this video. Perhaps nothing is as important to success as making good decisions. Decision analysis, DA, is a discipline for analyzing decisions under uncertainty. In DA, we capture judgments about risks and uncertainties as probability distributions. First use of probabilities in the foundation expected value calculation began in 1654. Mathematicians call this expectation theory. Expected value, EV, is simply a probability-weighted average of possible outcomes. Measuring outcome quality or value is at the heart of decision-making. This is decision policy. Decision policy is commonly separated into 3 elements: objective or objectives, and how quality or progress toward the objective is measured; time preference, which is, most often, time value of money; and, if necessary, risk attitude, expressed as risk policy. Let's take a look at a popular business decision policy. Most businesses are for profit. Their objective, at least the most important objective, maximizing shareholder value. For discussion, Let's assume we measure project outcome value in US dollars. Time value of money is recognized in the usual net present value equation. And risk attitude is important if the company is conservative in its decision making. Let's assume a company is risk neutral. Many widely held companies operate this way. Expected monetary value, EMV, is the probability weighted NPV outcome. EMV is expected value NPV. Your company may call EMV by a different name. Some companies use a synonym, mean NPV. The EMV decision policy is, choose the alternative with the highest EMV. This applies best when the objective is to maximize the EMV of the company. There are lots of decision aids. To be called decision analysis, the decision-making process must have these features. The decision maker has a way to measure outcome quality, such as NPV. Judgments about risks and uncertainties are captured as probability distributions. The first two are combined in the expected value calculation. And the decision rule is to choose the alternative with the highest expected value. The primary expected value calculation tools are decision trees and Monte Carlo simulation. Each tool calculates expected values, though in very different ways. Trees and simulation each have their advantages. Often, both methods are used for different parts of the same analysis. Let's take a quick look at a simple decision tree model of a capital investment decision. The decision is to approve or drop a project. For simplicity, we have only two possible project outcomes, success and failure. Success NPV is worth $10 million, net of the investment cost and taxes. Failure NPV is minus $5 million, losing the investment cost. A subject matter expert judges the probability of success, PS, at 60%. The probability of failure, PF, is then 40%. The bottom branch is a drop or do nothing case for comparison and has zero value. Decision trees are solved working right to left. The possible outcome values are the NPVs at the right. The circle represents a risk or uncertainty event. The node's value is its EMV. Here is the EMV equation. EMV is the sum of the outcome probabilities times the corresponding NPVs. EMV equals 0.6 times $10 million plus 0.4 times minus $5 million equals $4 million. This is the node value and placed on the branch leading into the node. Comparing alternatives, $4 million EMV is better than the drop project branch value of $0, so the better choice for the EMV decision maker is to approve the investment. We prune inferior branches and indicate elimination with cut marks. Thus, summarizing, this investment opportunity is worth $4 million to a risk-neutral decision maker. In this model, the actual project outcome will be either plus 10 or minus $5 million. However, over a long run, many investments like this will add $4 million NPV on average to the company. This example shows application of the EMV decision policy, which represents a neutral risk attitude. Imagine that you manage a department with a $20 million annual budget, part of a large organization. Consider this decision for a moment. Would you approve the risky investment? The guidance in many management books will say only that it depends on the decision maker's risk appetite, risk tolerance, risk aversion, or something similar. That's not very helpful, is it? I ask my public classes whether anyone knows his or her company's risk policy. Those participants who respond will mention one or several metrics or hurdles, such as payout less than 2 years, rate of return greater than 20%, discounted return on investment greater than 0.5, and others. None of these is adequate, individually or in combination. Risk policy is to guide in making risk versus value trade-offs. Consider two alternatives with uncertain outcomes, represented by these distributions. You have likely heard, to make more money, you need to take more risks. Here we have the classic decision dilemma. Alternative A, in red, has a narrow distribution indicating low uncertainty. B, the blue distribution, has a higher average potential value, the expected monetary value, but more uncertainty or risk. Scale and position matter. And let's assume that the lower possible outcomes for B would cause serious damage to you or your company's net worth. Which alternative would you choose? If you are risk neutral, the widths of the curves don't matter, only their EMVs. Determining the probability weighted average is straightforward. Since these curves are symmetric, the EMVs are in the distribution centers. The EMV decision maker would always choose B, regardless of scale and location of $0. EMV is an objective measure of value under uncertainty. The cash in hand value for B is its certain equivalent, CE. For a risk-neutral decision maker, the CE equals EMV. However, for the risk-averse decision maker, each alternative is worth less than its EMV. The CE is somewhere between the worst possible outcome and the EMV. That CE can even be negative when the EMV is positive. Where are we going with this? Using a utility function to express risk policy provides a way to calculate CEs. Think of a CE as a risk attitude adjusted EMV. Decision makers often override the EMV decision rule in important, risky decisions. This is rational and usually done with experience and intuition. A more consistent approach is to have and apply a risk policy expressed as a utility function. This idea is not new. Mathematician and scientist Daniel Bernoulli proposed a utility function in 1738. Utility functions are now well established in psychology and economics. Here are several characterizations of risk attitude as utility functions. On the charts, the x-axis represents the objective value measure, such as NPV. The y-axis represents utility or perceived value. Utility is how the decision maker feels about the outcome. This video and the Utility Elicitation Program assume that you are a conservative decision maker, meaning risk-averse, and that you want to be consistent in making value versus risk trade-offs. Using a utility function for risk policy provides that consistency. Let's focus on the right utility function, which represents a conservative or risk-averse person or organization. This curve is everywhere risk-averse. The utility curve translates a dollar NPV outcome, the x-axis, into utility units, the y-axis. Some call the utility units utils or utiles. Let's focus on the upper right portion of the utility function. You may recall the law of diminishing marginal utility from school or college. For most value measures, as we get more of it, the next increment is worth less to us. More is always better, but at diminishing value increments. On the left side of zero are NPV losses. People hate losses more than they appreciate gains. The negative utility is accelerating downward as loss worsens. There are infinite possible utility function shapes and several well-established formulas. Most decision analysts advocate an exponential utility function, so-called because an exponential function is in the simple equation. The 45-degree line represents risk neutrality, an EMV decision maker, with infinite risk tolerance. The curvature is defined by a single parameter, the risk tolerance coefficient. Its symbol is lowercase r. I call the y-axis units risk-neutral dollars. Utility is not real money. However, 100,000 risk-neutral dollars feels 100,000 times better than $1. R is just a scaling factor. Higher net worth people tend to be more risk tolerant and have higher risk tolerance coefficients. R is typically on the order of 1/5 of a person or company's net worth. As R is increased, the curve flattens against the 45-degree line. I have used this curve or similar for some personal decisions, such as investing in a share of a risky venture and in optimizing my portfolio across asset classes. Here R is $100,000. Conceptually, Warren Buffett and I have the same utility function shape. We just have different scales. Mr. Buffett has more zeros on the X and Y axes. Hypothetically, I'm assuming his R is $10 billion. Notice the curve does not change shape, only the scales. Here my curve, red, is added to the chart of his curve. At this scale, my utility function appears as a right angle. Zooming in, now we see curvature in Buffett's utility function for modest utility amounts. Most practitioners settle on the exponential shape because of its very desirable properties. For example, it does not depend upon the starting net worth of the investor or company. It also has the same values whether buying or selling a risky asset. I recommend this formula so that the units are more meaningful. I call the utility units risk-neutral dollars. The curve is scaled by the risk tolerance coefficient, R. Note that R appears twice in the equation. If you accept the exponential shape, then all you need for your risk policy is to determine R. This is how the equation might be expressed in Microsoft Excel. I've used RTC as a symbol for R because Excel reserves R for row. Don't be alarmed by the utility equation that converts outcome NPV into utility units. It is somewhat similar to the present value equation that converts a future net cash flow amount into net present value equivalent today. The upper equation is the form that most analysts use and recommend. The lower equation is equivalent but uses an exponential function instead. The point is that the utility calculation is similarly simple as the common NPV calculation. Let's pause to look at the decision landscape. Utility means value, however perceived and measured. We are all expected utility maximizers. Most people get through life knowing little about probability. They just risk-weight possible outcomes in their heads. Quantitative analysis can handle more difficult decision problems with structuring and quantification. In maximizing our life experience as individuals, we consider multiple objectives and metrics. Optimization requires some measure to optimize. Business decisions are easier when the single or paramount objective is to maximize shareholder value. The common metric is NPV. This can work well for individuals also who can express value and trade-offs in terms of monetary equivalence. Our discussion continues, assuming that maximizing a monetary value equivalent is the objective. NPV is the value measure if risk neutral, and NPV measures utility. However, if risk averse, the expected utility rule is simply maximize expected utility or equivalently maximize the certain equivalent, also called the expected utility decision rule because these two policies are interchangeable. They always indicate the same choice. Fortunately, for the vast majority of decisions, the effect of risk aversion is small, and the CE approximately equals EMV. The heart of most business decisions is a cash flow model. A cash flow projection goes into an NPV calculation. Risk weighting NPVs gives us an EMV. Do this for every alternative. If the decision is small or the decision maker is risk neutral, choose the alternative with the highest EMV, and you're done. If risk averse, convert every outcome NPV into utility units. Calculate expected utility, EU, for every alternative. In most cases, you can stop here and choose the alternative with the greatest EU. However, I recommend taking this one step further. Convert the EUs into certain equivalents, CEs. This gives you a cash-in-hand value for each alternative. Choose the alternative with the highest CE. We elicit a decision maker's preferences in defining risk policy. Again, we usually decompose decision policy into objectives, time preference, and risk attitude. Risk policy is best expressed as a utility function. With an abundant record of past decisions, we can, in concept, fit the utility function shape to the data. This is problematic because of insufficient examples and inconsistency. Another way is to interview the decision maker or a decision board. If we assume the exponential utility function shape, this greatly simplifies the process. Now we need only capture the decision maker's R. The interviewer could assemble real-to-life decision packages for consideration. However, simple decision problems are sufficient. We can present a decision maker with a series of simplified hypothetical decisions. From his or her responses, determine trial values for R. The elicited R values will likely vary widely until the decision maker's intuition about risk versus value trade-offs becomes calibrated through practice. Additional elicitations capture judgments about system and model structure and input values. I developed a utility elicitation program, UEP, to make the elicitation process easier. What we have now is a third version on a third computer platform. UEP's sole purpose is to help a user determine his or her risk tolerance coefficient. It simulates simple decision-making situations, much as we would do in a face-to-face elicitation interview session. There are 3 investment parameters, as we saw in the earlier decision tree. PS, probability of success, NPV of success, and NPV of failure. A planned enhancement is an option to replace the 2 single-point NPV outcomes with a continuous NPV outcome distribution. There are 3 question types. PS, you judge the minimum probability of success to accept or retain a risk. CE, you judge the certain equivalent of a risk. Share, you judge the optimal share you want of a large, economically attractive project. Questions may be worded in either project buy or sell perspectives. The generated questions are random, but reasonably scaled to your maximum typical investment amount. We want the risk and outcome amounts to be significant to you. Based on your answer, UEP calculates an R. Next are examples of the 3 question types. Here we have a solved decision tree for an EMV decision maker. This is the same tree we saw earlier. These outcome values are NPVs, net of taxes. The EMV is positive, indicating this as an economically attractive investment to a risk-neutral decision maker. The certain equivalent, CE, is the cash-in-hand value of this risk. CE is less than EMV for a risk-averse decision maker. What is the most you would be willing to pay to acquire this project? That amount is your CE. From your CE answer, UEP calculates R. Here I've scaled up this project. The amounts are in millions of US dollars. Assume 500 million is too much for you to risk on any project. What is your optimal share or ownership fraction of this project? UEP assumes project independence and no capital constraint. so you should always want a portion of the project to improve your portfolio. From your share answer, UEP calculates R. Now we're back to the example we saw earlier, though here PS is not given. Suppose you are a small business owner and occasionally make risky investments in the neighborhood of $10 million. A new project comes your way. Success is worth $10 million and failure would cost $5 million. Note, if $5 million investment is too high or too low for you to consider, add or subtract zeros so that the failure amount is important but not overwhelming for you. Your subject matter expert has not yet assessed the probability of success, PS. What is the minimum PS that you would require to be just willing to approve the investment? Write down or remember that number. We will use it in a minute. From your PS answer, UEP calculates R. Unless you are very experienced at judging risks versus value trade-offs, expect that your R's will vary widely. But with practice and feedback, your R's should converge around some number. When you settle on an R, then that plus the exponential utility function shape defines your risk policy. This chart shows computed R's for the PS type question in the last slide. Find your answer on the x-axis. Then go up to the curve and read across to the y-axis value. Let me show you an example. Suppose you judge that 50% is the minimum PS before you would approve this investment. The red dot is above the indifference probability, and the corresponding R is $10.4 million. Setting up hypothetical decisions scaled to the decision maker is a bit of a chore. So over the years, I've developed successive versions of UEP to help with the elicitation process. UEP presents a series of questions to the user. Then, after each answer, UEP responds with a calculated R. Microsoft Excel can solve the calculations that UEP performs. Here I have a spreadsheet set up for the PS question type. These are millions of NPV, EMV, or CE dollars, or millions of EU risk-neutral dollars. Note the same plus 10 million for success and minus 5 million for failure. I put in an arbitrary starting 0.8 value for PS and a ridiculously large value for R. We'll change these in a minute. Note that I've again named the R cell RTOL because R is a symbol reserved by Excel to mean row. The EMV is the probability-weighted NPV outcome. In the U of X column, the NPV outcomes are converted to utility units using the exponential utility equation. The written equation is above, and the Excel equation is below. Note that with a very high value for R, the utility value is almost the same as the NPV amount. And at present, EU equals EMV, 7 million, though in different units. Once we have EU, we can convert back to certain equivalent, real dollars, using this formula. Also, because of the extremely large R, the CE equals EMV, both $7 million. We have been looking at Excel screens copied and pasted into PowerPoint slides. I am now recording in live Excel. Now let's change R to something more reasonable, say $100 million. Notice that the EU and CE values have diverged from EMV. Now let's try $10 million. Now the difference between EMV and CE is substantial. And when R equals 1 million, the CE is negative. This means someone would have to pay the decision maker $3.4 million to take the risk. I'll reset R to a large number. Let's find the break-even PS that just makes EMV positive. I will use Excel's goal seek to set EMV equal to 0 by changing PS. So at PS equals 1/3, EMV equals 0. This is the minimum acceptable probability of success for an EMV decision maker. Of course, a risk-averse decision maker would require a higher PS. We want to solve R with a PS type question. Let's assume the decision maker says 0.5 is his indifference point. Let's now solve for R such that the CE and EU equals 0. Again, using goal seek, I'm going to set CE equal to 0 by changing R. R equals $10.39 million. This confirms the red dot solution we saw on the last slide's solution curve. Solving for R for a CE type question is similar and can be done with this same worksheet. Solving for R given the decision maker's optimal share of a large project is only slightly more involved and uses Excel's solver optimization tool. UEP is free for most people. Access UEP by entering this URL in your browser. This is the same portal used for accessing my Book Online supplements. If this is your first visit, click Register. If you are already registered, click Login. This is the sign-up form. Now you are seeing the UEP materials and link. The retrieval code box is for Book Online supplements that are emailed. Below are links to a selection of videos on the left and white papers on the right. The Utility Elicitation Program link opens UEP in a fresh window or tab. Here is the Utility Elicitation Program startup screen as UEP first appears in your browser. UEP randomly assigns question type and buy or sell perspective. This time the buttons are set for the PS question type and the buy perspective. The default currency units are K-dollars. This is just a label for the NPV, EMV, and CE amounts. You can replace K-dollars with up to 8 characters for your currency and any needed units multiplier. What is the maximum amount you would normally risk on any one project or venture? Enter this in currency units in the max investment field. This is used to scale questions approximately to fit your situation. The NPV failure amount is typically 0.5 to 1.1 times this amount. NPV failure is considered the project investment amount and the lowest or worst possible outcome. Click the Next Question button to generate an investment decision. Click the Random Question button to again randomize question type and perspective and to generate an investment decision. UEP has only 2 main functions. It generates a random question based on your settings, and it processes your answer in calculating a risk tolerance coefficient. A recently added feature is question codes. With these, you may capture a record of the questions, your answers, and the calculated R's. Enter parameters for designed or repeat questions. The View Session link at the page top displays all the questions, answers, and R's for your session. Here is a question UEP generated. This is the same example that we have been using. The user put in her answer 0.5 and pressed either the Enter key or clicked the green Go button. UEP quickly returns the calculated R value. Before answering the question, you may want to look at 2 additional information sections. Many people prefer a graphic. Below the text question and at the left is a chance node as we would represent this project or asset in a decision tree. And scrolling down further, we have a table. The first column contains possible PS answers. The second column are EMVs using that P/S. The third column is a popular criterion, discounted return on investment, DROI. This equals EMV divided by investment. And the last column is the probability that a portfolio of 10 identical independent projects like this will have a positive NPV outcome. UEP stores your session data only in your browser. Clicking the View Session link at the top will display your data as question codes. You can copy and paste these into a file. This Excel chart is an example of what you might do to display your data. We hope that, with practice and feedback, that your R's will converge around some number. Select your R and you now have your decision policy. Most everyone cares about risk at some level. If you are a conservative decision maker, then a quantified risk policy will be helpful for clarity and consistency. Judging risk versus value trade-offs is difficult with unaided intuition. A quantitative risk policy guides in making logical, consistent trade-offs between value and risk. The exponential utility function shape offers key benefits, such as same buy and sell values. UEP will help you determine the risk tolerance coefficient. If this approach to risk policy appeals to you, try UEP by visiting this URL. I would love to hear how this works for you. Here's that web link again to access UEP. There you will find other links to companion videos and white papers. I wish you success through better decision making. And thanks for watching.